Hi, in this chapter, we are going to talk about public and private financing. We're going to talk about initial offerings, we're going to talk about seasoned offerings, and we're going to talk about how investment banks manage both these for corporations who are trying to raise funds. Uh, the equity market is controlled by several agencies. One of the major ones is the Securities and Exchange Commission. It's based out of Washington, D.C., and its major job comprises of managing interstate public offerings, overseeing all the stock exchanges, trading by the management, which is corporate insiders, and ensuring that there is uh, a smooth transferring of information from the corporate to all individual investors as well as institutional investors. In addition to the Securities and Exchange Commission, you have the Federal Reserve Board, which controls the margin requirements. Margin requirements essentially allude to the fact that when you're trading, you can either pay the entire amount that you want to trade when you're buying a stock, or you can trade on the margin, meaning you borrow some amount of capital from your broker and you trade using that. Essentially, it's like a leveraged trading. So the amount of margin requirements that's needed for margin trading is controlled by the Federal Reserve Board. Now, in addition to the SEC and the Federal Reserve Board, the state actually controls issuance of securities within their boundaries. So if there is a equity offering that is within the state, then the state laws and rules apply. Whenever it's spans across several states, then you have the SEC that takes over. In addition to that, uh, for the securities industry, you also have the National Association of Security Dealers, or the NASD, uh, which takes actions to ensure the integrity and the credibility of trading system. Essentially, these are dealers who are standing on the opposite side of the market, making the market, ensuring that trading happens smoothly. uh, and essentially, in order to do that, they have this association called NASD, which lays out regulations on how these dealers should be behaving in the market. And it's the behavior of the dealers which ensures that, trading happens smoothly across the markets. So, why is it important that security markets are so tightly regulated? Well, there are several reasons. One of the major reasons is that if the security markets are not very well regulated, investors won't feel very comfortable when they're investing in the equity markets, right? So, in order to have a healthy financial market, you need to ensure that it is very well regulated, and hence you have all these entities and all these organizations. And we've seen time and time again that even despite having such stringent regulations, the US is one of the most tightly regulated security markets across the world. Uh, we still have situations or cases when the companies or there are bad actors, right? So in order to prevent this and in order to ensure the faith that the markets are fair, you need to have all these regulations. Uh, So how does this all start, right? So before we talk about IPOs and seasoned equity offerings, we should think about, what happens before an IPO or before a seasoned equity offering, right? So usually a firm starts by, some individual who comes up with a crazy idea and, you know, he pools together his or her own resources. So that's how most companies start. The founder has some resources, an idea, and he starts something. After that, usually what happens is that he'll, approach friends or family or some angel investors and then try and get the ball moving in the business. Once, uh, the business is established, or you at least have a proof of concept or, some initial understanding, you can approach venture capital funds for raising further capital. Now, venture capital funds, like the capital that we've talked about, can either be equity funding or it can also be debt funding. So, most capital is provided when in terms of venture capital funds by either institutional investors or by accredited investors. Managers of these funds are called venture capitalists, and venture capitalists typically the way they operate is they not only provide the capital, but they also provide some amount of guidance, and hence, at the early stages, you will find a lot of venture capitalists sitting on the boards of companies so that they can guide and ensure the company is doing the right thing and it's growing the way it's supposed to grow. And at the same time, it provides an opportunity for the venture capitalists to ensure that their funding is, not being wasted and it's going to the right places. So there are two types of, ways in which funds can be raised. One is called a private placement, and the second is called a public offering. In a private placement, which is usually the case when you're raising funds from angel investors or venture capitalists, uh, securities are only sold to a very few investors rather than to the larger public. It's not open to everyone. It's only open to a small section of people, and even these small section of people, they are considered or assumed to be accredited investors. In a public offering, like the name suggests, securities are offered to the public, and when you're offering securities to the public, because you're dealing with the money from retail investors as well, you have to be registered with the Securities and Exchange Commission, because the Securities and Exchange Commission is going to oversee once you are a publicly traded company. You come under the purview of the Securities and Exchange Commission, and you have to abide by all the rules and regulations. Uh, the privately placed stock is usually not registered, so sales must be only to accredited high net worth investors. The way it happens is that you send out an offering memorandum, which is basically 20 to 30 pages of data information, which is prepared by security lawyers, and then the buyers certify, that they meet the net worth requirements to be an accredited investor, because when you're investing in a private placement, the investments are much more risky. Given the riskiness, it's assumed or it's deemed that it's not fit for regular investors who could lose a lot of money. At the same time, it opens the doors for bad actors, people who are trying to just fleece other investors, and they can come up with a story and everything. And so you need to be an accredited investor in order to be able to afford to take such risks, because these are much more risky investments. That's why regular people are discouraged to invest. Of course, now there are ways and means in which you can also invest or participate in venture capital, but then again, it's not very straightforward. Uh, So for a corporation, now that we've noted that you either have those options that you can either do a private placement and raise funding from venture capital, or you can just skip the entire venture capital route and you can just go public instead. But typically, the way it happens is that the companies these days, the way they get or become public is they first have angel funding coming in, then they have venture capitalist funding coming in, and then they have the private equity investors who also invest. And once you've exhausted all these sources of funding, it's only then that you try and go to the public markets. And even when they're going to the public markets, it's usually not the case that they're trying to raise capital, but what they are trying to do now is that they're either trying to create value or determine the value of the company and provide an opportunity for the angel investors, the venture capitalists, and the private equity investors, as well as the founders, to exit their overall holdings in the company. So here are some of the advantages of going public. The first one is that the current stockholders can diversify. Imagine a founder of a company and his or her bulk of net worth is tied to the company, right? So if the company goes bust, then this individual is going to lose everything. But once a company becomes public, now they have an option that they can sell their shares, right? And thereby diversify their overall holdings. Uh, Liquidity increases, meaning that the stock that the company had previously, which was only traded among a few set of people, now the larger public can also invest and trade. So liquidity all of a sudden increases significantly. It makes it easier in to raise capital in the future. You don't have to just go to a small set of people like your private equity investor, your venture capitalist, but you can just go to the equity markets and raise capital, both equity as well as debt. People are much more comfortable investing in publicly listed companies than private companies. Going public, like I mentioned before, establishes firm value because there's so much trading happening. Prior to going public, companies can have, very high or very low valuations, right? Everybody, I'm sure, has heard of these unicorns, these billion-dollar startups, which, are not making any money in several situations. Once these big mega unicorns get publicly listed, you know, given that the amount of trading goes up significantly, uh, the value of the firm is actually discovered. That what should this firm be actually worth, right? Uh, Also, once a company is publicly listed, it makes it much more easier to use stock as employee incentives, either in the form of stock options or restricted stocks or stock grants and awards, right? Uh, if you have a stock that is not publicly listed, owning that might not, on paper it might be worth a lot, but in actuality, if you can't sell it, then it's probably worth very little, right? So once a company goes public and the stock becomes publicly traded, uh, it opens up all these doors for employee incentives and employee compensation. And finally, it also increases customer recognition, right? So if you are a customer or if you're a supplier of any publicly listed company, it adds a lot more credibility when you're dealing with a publicly listed company rather than a privately listed company, right? Uh, so it has all of these advantages, but there are also certain disadvantages to going public. The first one is that now, because you're under the purview of all these organizations that are trying to regulate you, and essentially they're trying to regulate you so as to ensure that your investors are protected. But because of that, now you have to file several reports. You have to disclose all your operating data, which means now your competitors know what's going on, what your margins are like, what line of businesses you're involved in, which geographies you operate in. Everything is now available to your competitors. And at the same time, your management, your board of directors, your CEO and CFO and CTO, all of them, the C-suite will now have to disclose how much they own in the shares, right? There's this one very common trading strategy where people follow if company insiders, meaning the top management, whether they are buying or selling stock, right? So if they're buying the company stock, it is usually considered to be a good signal because the assumption is that the management knows more about the company than anybody else. So if the management of the company is buying shares, then they believe that the shares are underpriced. So all of their holdings and their insider tradings have to actually be disclosed to the SEC, right? Just because you are a CEO and you know that your company's earnings results are going to be better than what the market is expecting, should not give you the opportunity to trade on that information, right? So whenever the management of the company trades, they actually have to give out a schedule of when they are expecting to make any planned sale of purchases of security, and all of that actually has to be spelled out. They just can't trade whenever they want to. Especially, I think there's a window around major announcements, material announcements that they cannot trade around. But the entire market is actually looking at what the management and what the board is doing whenever it comes to buying or selling of shares. Uh, it can also make it very difficult to give special deals to insiders. So, the compensation of the CEO or the board is now available for shareholders to see, right? So you cannot make them any special deals. Everything is now out in the open. Uh, if the company goes public and it's only a very small company, then it might not generate the amount of interest that we're talking about in the previous slide. And that might mean that it's probably not going to be actively traded. So all the things that we talked about establishing of value, about liquidity, those things are no longer relevant. So unless the equity issuance is big enough or the market capitalization of the company is big enough, there might not be a lot of the benefits that we're talking about with going public, but all the hassles about, you still have to make all the filings and disclose everything. And finally, the final disadvantage of going public is that you have to have a dedicated investor relation team, and they will have to manage all the uh, filings that need to be made with the SEC and make sure that investors are made aware of all the documents. So uh, all in all, while there are certainly a lot of advantages, there can also be several disadvantages to going public. So here's what happens when a company is trying to go public. These are sort of your steps in the IPO process. The first you start off is that you select an investment banker. You cannot do an IPO on your own. Uh, there are other forms of going public where you can actually avoid, having to have an investment banker. For example, Spotify, when they went public, they did something called a direct listing. And I'll talk a bit about the direct listing once we know what the IPO process is. So in the IPO process, this is what happens. First, you select an investment banker, like your Goldman Sachs or your JP Morgan or your Morgan Stanley or your Merrill Lynch. Uh, Once you have selected the investment banker is going to file a registration document with the SEC telling that, hey, we want to bring this company public. Uh, the investment banker is going to work and decide upon a preliminary price range of what the share price would be, uh, listed at. It's called the red herring or the prospectus. And then once you have that preliminary price band, you go on what is called a roadshow. Essentially, you go to the major financial hubs and you talk to institutional investors and try and gauge their demand for this, security that you're offering. And once you go on the roadshow, you get like a better understanding of what is the demand for the stock and what prices, it's okay for you to sell the stock for. Now, in this entire process, once you have an investment banker, you have to understand that how the risk is overall played out. So the investment banker basically, once the company hires the investment banker, the risk is all transferred to them. Uh, the way an investment banker is chosen is that they are given a percentage of the entire proceeds, and usually it's a pretty high number, somewhere in the neighborhood of 5 to 7%. So 5 to 7% of the entire money that's going to be raised is going to go to the investment banker in fees. Uh, but at the same time, the investment banker is responsible once the price has been decided that they are going to be able to get the company that price at which they've promised that they are going to be able to list the security. Uh, so given that the risk is largely on the investment bankers, typically the way they price the IPO is that they try and keep the price slightly lower than what the price should actually be. And because of this, sometimes what will happen is, or in most cases, what you will notice is that the first day returns for most IPOs is on the positive side. So here are some of the criteria that one should keep in mind when they're choosing an investment banker. Of course, you need to look at the reputation and the experience that they have in the industry. What kind of clientele do they have? Because at the end of the day, the roadshow is going to be successful if they are able to get promises from these clients that they are going to subscribe to the IPO, and what kind of support can they provide after the IPO. Because at the end of the day, the relationship with investment bankers is not just for getting the IPO out in the market, but these are the same set of people or the same companies that are going to, eventually become equity research analysts, and these are the same people who are going to follow your company, right? So it's in the interest of the company to ensure that, once you form a relationship with an investment bank, that you continue to maintain it, and make sure that, the relationship keeps getting better. Uh, so One of the ways in which you negotiate a deal with an investment banker is called either a negotiated deal or a competitive bid. In a negotiated deal, you basically negotiate with the investment banker versus in the competitive bid, basically a lot of investment bankers compete for the business. The competitive bid process is only feasible for extremely large issues by major firms. So, whenever the issuance is big, many times what happens is that, there's usually like a main or a lead underwriter, and then there are other banks, investment banks that participate and work together. Uh, So even here, the use of bids is rare for equity issues, and it is very costly for investment bankers to learn enough about the company to make an intelligent bid, right? Because the company is a private company. So the competitive bid is usually not the norm. It's mostly the situation that what you have is a negotiated deal, and usually the company negotiates with more than one investment bank before finalizing on which investment bank they're going to go with. Uh, After the deal has been negotiated, the deal's basis is either going to be underwritten or a best efforts basis. The difference between the two is that in an underwritten offerings, which is the most common one, the investment banker bears all the risk, right? So um, they underwrite and they promise that, hey, we are going to get you, when these shares are going to get listed, we are going to get you this price, or we are going to ensure that all these shares that we are planning to list gets listed. Uh, the other option is that, they undertake the deal on a best efforts basis, where they will say that, hey, we are going to try and get you the best price. And then, whatever happens, you cannot hold them accountable. So in an underwritten deal, the price is not set until the investor interest is assessed and oral commitments is obtained. So essentially, after the roadshow, the company and the investment banker know what the price they should be getting, and once the price has been decided upon, then the investment banker is held accountable to that. But on a best efforts basis, there is no such accountability. Now, the best efforts basis is usually done for issuances that are very small and risky, but most common is the process where the investment banker underwrites it, basically taking the risk away from the company and taking most of the risk on their own. So here are some of the ways in which the stock is priced during an IPO. Like we've done, when we discussed chapter 12 and 13. You have your free cash flow valuation model, which is also called the discounted cash flow model, or you use a relative valuation model, something like the price to earnings ratio, or the price to cash flow ratio, or the price to sales ratio. Sometimes because the company has negative earnings and you cannot use the PE ratio, or even there are some companies which go public without having any sales, then you get creative and use ratios or metrics like the number of visits to web pages. This used to be very common during the 2000 .com bubble. Once you decide on the valuation method, the next thing is that you decide on how much dollars a company needs, right, in order to understand or estimate the overall number of shares that will be issued. So there are two things, right? One is, of course, you need to determine what price you're going to sell the shares for, and the second thing is how many shares are going to be offloaded, right? So in order to decide that, you need to know two things: the amount of money that the company needs, and the second is what percentage of the company the owners or the private equity investors or the venture capitalists or the angel investors who've initially funded the company so far want to sell off or retain, right? And once you have these two pieces of information, you determine the offer price, and this is how it happens. So here's an example. So let's say there's this company whose pre-IPO value of equity was determined to be around 63 million, and already this company has 4 million shares. So which gives us, if you try and calculate the share price of the company pre-IPO, the share price of the company works out to be 63 million divided by 4 million shares. is $15.75. So that's the share price of the company before the IPO. Now let's say the company needs to raise an additional $18.6 million dollars, and the underwriter is going to charge a 7% fees. So whatever amount of capital the underwriter is going to raise, on that they are going to charge a 7% fees. So if the company needs a net proceed of 18.6 million, then basically they have to raise more than 18.6 million because they have to compensate the uh, underwriter for the 7%. So you take the 18.6 million divided by 1 minus 7%, which gives you around $20 million dollars. So if the company raises additional capital of $20 million dollars, then after paying the underwriter's fees of 7%, they are going to get 18.6 million. So this is how much they need in new capital. So they want to raise 20 million, because only if they raise 20 million, then they're going to get 18.6 million dollars. Now let's let's look at the value of the company. So after the IPO, the company has raised new capital. Prior to the IPO, they already had $63 million dollars in valuation, and now they have raised another $18.6 million dollars. So if we add 63 million to the 18.6 million, a post value equity valuation of of the company is now standing at 81.6 million. Now the next thing that we need to determine is we need to determine at what price is the share going to be priced after the IPO, right? So determine the percentage of post IPO value in the firm that investors require, right? So the first thing is out of the company, uh, you know, the new capital that is being raised is around $20 million, correct? Even though the company only gets $18.6 million, the capital that is being raised is 20 million. The total capital after IPO for the company is going to be 81.6 million. So the new capital that is being raised, or the new shareholders are now going to be, 20, the new shareholders are going to own 24.5% of this company, right? That's what they will require. So this is how you determine how many new shares are going to be issued in order to ensure that the new shareholders get 24.5% and the previous shareholders get the remainder of around the 86% mark, right? So this is the formula that is used to calculate how many new shares are going to be issued. Now another simple way of thinking about this is basically that what you're trying to understand is that 1 minus the 24.5%, that is now 4 million shares, right? What you want to calculate is what is 100% equal to, right? So if you use the formula to calculate the number of new shares, right? The number of new shares is nothing but percentage of the new shares times the number of existing shares divided by 1 minus the percentage that is given to new shareholders. And that gives us that we need 1.3 million new shares. Now, if you want to you know uh, think about it in another way, we know that 4 million shares is what with the number of shares previously, right? Now 4 million of shares equals around 25.4, so this is 75.5%, 75.5%. So what is 100% equal to, right? So you take that and you take the 4 and you divide it by 1 minus 0.2451, and basically what you get is 1 minus 0.2451 is 1 minus 0.2451 is 0.7549%, so 75.5%. Uh, and you invert it and then you multiply it by the 4 million number. So basically the new number of shares that's going to be outstanding is going to be 5.3 million. So now that we have calculated the number of new shares, the next step is to calculate the share price. Uh, so the company is essentially raising $20 million, right? And we know that in order to do so, they are going to issue 1.3 million new shares. So that gives us a share price of 15.38. Now, if you compare this to the company's pre-IPO value, the company's pre-IPO value was 63 million and they had 4 million shares outstanding, right? Which give a share price of 15.75. And basically the difference between 15.75 and the post IPO price of 15.38, it largely stems from the 7% that is lost while having to pay the investment bankers. So let's see what is it that these investment bankers are doing that demands this high fees that they are charging this company. So we've already talked a bit about the roadshow, but here's what happens during the roadshow. The senior management, the investment banker, and the lawyers, they visit potential institutional investors. They travel 10 to 20 different cities in a 2 week period, making 3 to 5 presentations every day. So it's a very hectic process for everybody involved. Uh, the caveat is that because the company is now in this quiet period, the management can only talk about things that they have mentioned in the prospectus. They cannot divulge any new pieces of information. Now, as the investment banker is visiting all these cities, they basically try and understand or gauge what the demand is. So they will talk to the investment institutional investors and ask them how many shares do they plan to buy. And based on that, they will have an understanding of whether the issuance is oversubscribed or undersubscribed. Usually, for issuances that are oversubscribed, they know that it's going to be easy to be able to raise the price if they need to raise the price, right? So it's easier for them to set a price once they have this demand from all the different investors. If you think about the overall process, it's the investment banker, once they are, once they've taken on this process, that they bear most of the risk, especially in the case if they've underwritten the issuance. Because of that, what they usually tend to do is that they usually tend to be very conservative when it comes to the pricing. And because of that, typically what you end up seeing is that for most of the IPOs, at least for 75% of IPOs that have happened historically, the prices typically go up on the first day. And the average first day return is close to 17%. So, in addition to the 7% that companies are paying the investment banker, they are also essentially leaving 17% on the table, because if they had priced the share slightly higher, it would have probably still sold, right? Given that the investment banker does not want to take a lot of risk and they want to ensure that, the promises that they've made during the underwriting process, they're able to maintain and uphold them, basically entails or ensures that, there is money being left on the table. And almost 10% of IPOs actually have had the first day returns of as high as 30%. For some companies, it's been well over 100%. So a lot of money is left on the table. So overall, this process is not inexpensive. It's very expensive if you add the money that's left on the table, as well as the fees that the investment banker is charging. So sometimes company tend to not go for the IPO process, but there's also another way in which companies can actually get listed. Uh, it's like what Spotify did with doing a direct listing. In case of a direct listing, essentially what happens is that the company just goes to the stock exchange and says that, hey, we are going to directly list our stock. And usually in the case of a direct listing, there is no additional capital that is being raised. Basically, the existing shareholders, they get the opportunity to put their shares out in the public markets, and investors, they just buy the shares, right? And depending on the prices that investors quote, the price is determined. So it's different from the IPO process, where the book building process sort of determines the price. In the direct listing, it's essentially the trading that determines what the pricing is going to be. So the first day returns are due to a conflict of interest between the company and the investment banker. Like I was saying, that there is an inherent conflict uh, because the investment banker has two motivations that set him to set a low price. One is to make the institutional investors happy, because if the institutional investors can make money by investing in the IPO, right? Because if they're entering into the IPO before other regular investors are, and if they can do so, and if the prices go up, then they are happy, right? And the second motivation is that it makes it easier, or much it makes it easier to sell the overall issuance, right? If they are pricing it at a lower price. It's like, imagine you're trying to sell something, and you know on one hand, if you ask for the full price, and on the other, if you ask for a discounted price, the commodity that you give a discount on has a much higher chances of selling, right? And that's essentially what the investment bankers are doing by pricing the issuance at a lower price. The firms typically would like the price to be as high as possible, right? Because they're trying to raise capital, they're diluting their equity, so they would want to get as high a remuneration for that as possible. The original owners, they typically only sell a small fraction. So if prices do increase, then they don't lose out a much. They don't lose out a lot. But if company is issuing new capital, and if money is being left on the table, like what we saw in the example, the share price that typically was charged was much lower, despite the fact that we only took into account just the 7% fees. On top of that, if the share prices were even lower, then there's more money being left on the table. And also, if the first offering goes well, if it's oversubscribed and investors see and find out that the returns were very high on the first day, then typically it creates a precedence, and follow-on offerings, whenever the company is trying to raise additional capital through uh, secondary equity issuances, they usually go much better once they have this record of issuing stock. Uh, so here's the longer term returns. Usually, the longer term returns don't look as rosy. The 2-year returns following an IPO is lower than the returns for non-comparable, comparable non-IPO firms. And on average, the IPO offer price is usually too low, and the first day run-up is too high. Right, so the long-term IPOs don't perform that well, but in the short term, the prices are much, the prices go up significantly. Uh, so here are some of the direct costs. Like we've talked about, the underwriter usually charges this 7% spread between the offer price and the proceeds. And also you have to pay the lawyers, the accountants, and everybody in between, right? Because the book building process, the roadshow, all of that is very expensive, and it can cost somewhere around $400,000 to the firm. In addition to this, there is the indirect cost, like what we were talking about, money left on the table because you're offering the shares at a lower price in order to ensure that the overall issuance is subscribed. So a typical IPO raises about $70 million dollars and leaves around $9 million dollars on the table, right? So if you add to this the 7% fees, so 9 million plus 4.7% of 70 million is 4.9 million. So that's around $13.5 million dollars is what you're leaving on the table, right? So in order to raise $70 million, you're spending 13.5 million. That's a very high cost. And that's one of the reasons why, companies, when they're trying to raise capital, IPO is not, it's something that they do at a very later stage, right? Because it is a very costly proposition. In addition to IPO, there are other methods in which companies can actually go public. We've talked about the direct listing. The other options are what is known as an equity carve out. An equity carve out is similar to a spin-off, but there is a slight difference. So in a spin-off, what happens is that a subsidiary of a company, you know, gets listed. But the difference is that in the spin-off, no new capital is raised, whereas in a carve-out, the parent company, creates a new publicly listed company by selling stock uh, of the subsidiary to outside investors. So it raises new capital. Uh, at the same time, they usually retain majority control. So let's say, uh, a company is doing a carve out. For example, I think DuPont is one of the companies that recently did a carve out where they sold a division, right? However, they did not sell the division to equity investors. They sold the division to another company. But basically, they are raising additional capital. In a spin-off, usually, a subsidiary is listed, but the existing shareholders get shares of the spin-off company. So no new outside investors are invited. So an example of a spin-off would be when Raytheon spun off Otis, right? So Raytheon used to own Otis, and they basically, you know, spun it out, and Otis became a new publicly listed company. The other ways of accessing the capital markets are secondary offerings. So once you've done a IPO and the company is already publicly listed, you can also go back to the equity markets and issue new shares. There are two ways in which you do a seasoned equity offering. It can either be a public offering where you again, hire an investment banker, pay the investment banker the fees, and raise capital doing that, or you can do a what is called a PIPE investment, which is a private investment in public equity. Again, you just instead of going to everybody or to the public in general, you basically approach accredited investors, and they basically take a position in your corporation. In addition to this, you can also do a self-registration or a private placement or an asset securitizations. These are other ways to raise additional funding. Uh, After the 2008 financial crisis, one of the reasons why the crisis probably happened in the first place was that there was a repeal of the Glass-Steagall Act, which basically allowed investment banks and commercial banks to sort of merge. So investment banks were essentially, dealing with the deposits from regular investors. After the 2008 financial crisis, our lawmakers wanted everything to go back, and they wanted to prevent a situation where commercial banks also had investment banking arms and were taking on a lot of risk. They did not want that to keep happening. So there was again this separation where commercial banks remain commercial banks and investment banks remain investment banks. As a result, a lot of these investment banks which had you know depository institutions attached to them, they actually let them go. So investment banks companies typically engage in underwriting debt and equity. That's their original line of business. Help with mergers and acquisitions, and not engage in commercial banking. So these are some of the other activities that they do. They do mergers and acquisitions. They do securitization. They manage assets for clients, and finally they sometimes also have trading desks, right? So these trading desks serve multiple purposes. Sometimes they trade the company's own capital, and they are called a proprietary trading desk or a prop desk. At other times, these trading desks help their clients for situations like share repurchases, right? So these are the trading operations can have several functions. At other times, they also do some market making activities. They serve as dealers. So the trading operations also can be very significant. Uh, so investment banks were in 2007, they were very levered. Uh, they were taking a lot of positions in risky assets. And after 2014, once the crisis got over, there was a lot of controls that were put in place. So many of the failed investment banks were sold. Bear Stearns was sold. Merrill Lynch was sold to Bank of America. Lehman Brothers got bankrupt, right? Or converted into banks to make sure that they get TARP funding, which was Goldman Sachs. TARP was essentially the Fed's way of repurchasing the toxic debt that was issued during the financial crisis and basically ensuring that financial institutions were made whole. Uh, Sometimes companies, instead of going public, actually can also go private. So going private is essentially the reverse of going public. Typically, the firm's managers, instead of trying to raise capital, the way they take it public is one of these two ways. The management of the company, basically, they want to be they want to have more freedom, right? And they believe that by not disclosing or by getting away from the scrutiny of the equity markets, then they can do better for the company. So they approach usually private equity investors, and what they do is that they use a lot of debt in addition to some amount of equity raised by these private equity investors to essentially buy out all the equity in the company. This usually happens in scenarios or in cases when the management typically believes that, for some reason or the other, the markets are not pricing the company's equity fairly, and the shares are actually underpriced. Uh, the new equity holders usually use a large amount of debt financing, so the transactions are called LBOs or leveraged buyouts. Uh, Here are some of the advantages of going private. It gives managers more incentives and more flexibility in running the company. They don't have to, publish quarterly reports every quarter. They're not getting judged by equity analysts who provide like that, hey, this should be the expectations in terms of earnings, and they have to meet the expectations. So all that pressure is taken away. It also removes the pressure to report high earnings in the short run. And after several years as a private firm, owners typically go public again. And during this time, essentially, they manage to make the company a much more profitable entity. An example of a company that has done this very successfully is Dell. Michael Dell took the company private, and then I think it's back public again. That's all for chapter 18. If you have any questions, do feel free to reach out. Thank you.